It often starts with a simple question. An investor opens their brokerage account and types in ETF. Hundreds of options appear. Some track the S&P 500. Others promise to outperform, rotate sectors, or actively capture opportunities. Two words quietly divide them: index and active. At first glance, the difference seems small. Both are ETFs. Both trade during the day. Both hold baskets of securities. But over decades, the distinction between index ETFs and actively managed ETFs can shape outcomes in ways that most investors underestimate. So, which wins long term? To answer that honestly, we need to move past marketing and into structure, mathematics, and history. Let's begin with index ETFs. An index ETF follows a rules-based benchmark. It doesn't try to predict which stock will outperform next quarter. It replicates an index, like the S&P 500, the NASDAQ 100, the MSCI Europe, or a total market index. If a company enters the index, the ETF buys it. If it leaves, the ETF sells it. The process is systematic, transparent, and mechanical. There is no forecasting, no macroeconomic opinion, no attempt to time recessions or rallies. Now consider actively managed ETFs. Active ETFs employ portfolio managers who make discretionary decisions. They overweight certain sectors, underweight others, select specific companies, adjust positions based on earnings outlook, valuation, or macroeconomic forecasts. The goal is simple: outperform a benchmark after fees. That word, after, matters more than most people realize, because performance in financial markets is not just about gross returns. It is about net returns, what remains after costs, trading expenses, and taxes. Let's introduce the first structural difference: fees. Index ETFs are typically inexpensive. Expense ratios for broad index funds in the US can be as low as 0.03% to 0.10% annually. In Europe, similar low-cost options exist. Actively managed ETFs generally charge more. While still often cheaper than traditional active mutual funds, many active ETFs range between 0.40% and 0.80% or higher. At first glance, the difference between 0.05% and 0.75% may not seem dramatic, but compounding magnifies small percentages. If two portfolios earn 7% annually before fees over 30 years, but one pays 0.05% and the other pays 0.75%, the lower cost portfolio can end up tens of thousands of dollars ahead on a six-figure investment. Fees compound negatively, and this is not theory, it is arithmetic. Now let's move to performance persistence. For active management to justify higher fees, it must consistently generate excess returns, what professionals call alpha. Academic research over decades has examined whether active managers outperform benchmarks after costs. The data is clear, though nuanced. In most large-cap equity categories, the majority of active managers underperform their benchmark over long horizons after fees. In the US, reports such as the SPIVA scorecard have repeatedly shown that over 10 and 15-year periods, a significant percentage of active funds fail to beat their respective indexes. Europe shows similar patterns in many categories. But the story does not end there. There are periods when active managers outperform. During highly concentrated markets, like the late 1990s technology bubble or certain post-pandemic surges, active managers who avoided overvalued sectors sometimes preserved capital better. In extreme downturns, certain active strategies have reduced drawdowns through defensive positioning. So the question becomes deeper. Is outperformance possible? Yes. Is persistent outperformance common? Historically, no. This introduces the second structural challenge: consistency. Even when active managers outperform over a short period, say 3 years, performance persistence is rare. Funds that rank in the top quartile during one period often regress toward the mean in the next. Markets are competitive ecosystems. When inefficiencies appear, they tend to narrow as capital flows adjust. Index ETFs, by contrast, make no claim to outperformance. Their objective is to match the market, minus a small fee. This humility is their strength. Now consider behavioral finance. Many investors choose active ETFs because they believe someone is steering the ship. The idea of a professional adjusting exposures during volatility feels reassuring. But behavioral research shows that investors often chase recent performance. They buy active funds after strong returns and sell after periods of underperformance. This timing behavior frequently reduces actual investor returns relative to the fund's reported returns. Index investing reduces decision points. Fewer tactical shifts mean fewer emotional reactions. However, there is a legitimate debate worth acknowledging. As passive investing grows, particularly through index ETFs, some critics argue that too much capital tracking indexes could distort price discovery. If money flows automatically into index funds, companies included in indexes may benefit disproportionately. Yet active managers still set prices at the margin. They analyze earnings, adjust valuations, and make discretionary trades. The ecosystem remains interdependent. Let's also address market environment. In highly efficient markets like US large-cap equities, informational advantages are difficult to sustain. Competition among analysts, institutional investors, and quantitative firms is intense. In less efficient markets, such as small-cap stocks, emerging markets, or specialized credit segments, active management may have more room to add value. So context matters. Another key difference lies in transparency. Most index ETFs disclose holdings daily and follow clear rules. Active ETFs also disclose holdings, but their strategies may be less predictable. Investors must understand what they are buying. Now consider risk. Index ETFs accept market risk fully. If the market declines 20%, an S&P 500 ETF will likely decline close to that amount. Active ETFs may attempt to reduce risk through diversification, cash allocations, or sector shifts. But these decisions can also lead to underperformance during strong rallies. There is no free lunch. Reducing downside often means sacrificing some upside. Long-term wealth building requires clarity about trade-offs. So which wins long-term? If history is our guide, broad, low-cost index ETFs have delivered consistent market returns with minimal cost drag. Over long horizons, 20, 30, 40 years, matching the market at low cost has proven remarkably effective. Active ETFs offer the possibility, but not the guarantee, of outperformance. Success depends on manager skill, discipline, cost structure, and market conditions. The deeper issue may not be performance alone. It may be temperament. Some investors prefer the systematic certainty of index investing. Others value the flexibility and conviction of active management. In practice, many sophisticated portfolios blend both, using index ETFs as a core and selectively allocating to active strategies in specific areas where inefficiencies may exist. But the final insight is this: markets reward discipline more reliably than prediction. If an investor cannot tolerate underperformance during certain cycles, active strategies may lead to constant switching, buying high and selling low. If an investor accepts market returns and focuses on cost control, the probability of long-term alignment increases. So perhaps the real question is not simply which wins. It is this: are you building your strategy around evidence or around optimism? Because optimism can be expensive. Evidence compounds quietly, and over decades, quiet discipline has historically outpaced confident forecasting. The choice between index and active ETFs is not a battle between good and bad. It is a decision about structure, cost, persistence, and behavior. Which structure aligns with your understanding of markets and with your own temperament? That question may matter more than any single performance chart. This is Finance Guro, where we don't chase noise, we study reality.